Good day, everyone. Welcome to our webinar on the moving average. This is a very important, basic technical indicator that everyone needs to know. The moving average is perhaps the simplest and the most widely used of all the line indicators in technical analysis. It is often used in conjunction with other line indicators to eliminate noise or to highlight the trend. It also provides the user with a buy signal close to the bottom of the trend and a sell signal close to the top. How does it work? The best way to explain how to calculate a moving average is with a simple example. Consider the diagram. Here you can see a share's daily price over 35 periods. These could be days or weeks or months, it really doesn't matter. And that could be represented in a chart which looks like this. To calculate a 10-day moving average and the moving average for the 10th day, you must add up the first 10 days and then divide by 10. The average should then be plotted on your chart on the 10th day. Then, on the next day, when you get the closing price for that day, i.e. day 11, you add that into your average and remove the oldest day, i.e. day 1. So each day, you add the most recent day's price, take off the oldest day's price, and recalculate your average by dividing by 10. So your average always has only the most recent 10 days. And every day you move the average 1 day forward, but always keeping 10 days in the average, hence the term moving average. Your chart with the moving average will look like this. Immediately you can see that the 10-day moving average smooths out the fluctuations in the share's price to reveal the underlying trend. It also provides a sell signal and a buy signal, where it crosses over the price chart. A sell signal is given where the price cuts down through the moving average, and a buy signal when it cuts up. Let us consider now how this works in the real market. Look at this chart of an index. You can see here that the chart is volatile, and the index moves up and down on a daily basis in an apparently unstructured way. And yet there is a trend. To isolate that trend and smooth out the fluctuations, we can apply a 120-day moving average. A 120-day moving average is exactly the same as a 10-day moving average, except that it includes 120 days. So it is calculated by adding up 120 days of prices and then dividing by 120. You can see that the chart begins with a downward trend, and then there is a period of sideways movement, and then an upward trend. The moving average helps to eliminate all the noise in the chart and show the downward and upward trends clearly. It also gives a sell signal close to the start of the downward trend and a buy signal close to the beginning of the upward trend. Let us apply that moving average and see how it smooths out the chart. Now let us consider a more complex chart with a simple 200-day moving average. You can see here that most of the time the 200-day moving average has worked reasonably well, giving buy and sell signals. However, in the middle of the chart there is a whiplash, where the index moves sideways, crossing and recrossing the moving average, and giving a series of buy and sell signals at more or less the same price. During a sideways market like this, the moving average buy and sell signals do not work. They only work when the index is trending strongly upwards or strongly downwards. You will also notice that the sell signal is given very late, well after the start of the downward trend. Now let us add a second 65-day moving average to the same chart. You can see that the shorter 65-day moving average gives a much earlier buy and sell signals. But it also gives far more signals and gets whiplashed far more than the 200-day moving average. The shorter your moving average is, the more closely it will follow the underlying index. But this results in more invalid signals. One approach which can improve the timing of signals is to buy when the 65-day moving average breaks up through the 200-day moving average and to sell when it breaks down. In fact, technical analysts often use 3 or more moving averages in conjunction with each other. Obviously, you need to experiment to find out which moving average or set of moving averages gives the best signals on the share or index which you are studying. So the rules are simple. When the moving average is below the price or index, you should be in the market. And when it is above, you should be out. You can also use the slope of a long-dated moving average on the S&P 500 index to determine whether the markets of the world are in a bull or bear trend. Consider this chart of the S&P 500 index going back to 1992. The key is to look at the slope of the long moving average. While that slope is in an upwards trend, markets are in a bull phase, and vice versa. The chart begins with a long bull trend that began in August 1994 and lasted until about February 2000. This was followed by a bear trend, which lasted until about April 2003. The next bull trend then ended in about March of 2008 when the subprime crisis began. That downward trend lasted until March 2009, when the current bull trend started. And of course, we are still in that current bull trend, and you will notice that throughout the 10 years of that bull trend, the long-dated moving average has remained upward sloping. It's never turned downwards, even though there was a considerable amount of whiplashing during the 10 years, and a lot of times the index actually broke down through the moving average, but it did not turn the slope of the moving average downwards, and that's the important point. So you need to choose a long-dated moving average which suits you and apply it, we suggest, to the S&P 500 index, because that is a very good benchmark index for all the markets of the world. And then that will determine when you are in a bull trend or a bear trend. And of course, that's very important for private investors to know whether you're in a bull trend or a bear trend, because basically, in a bull trend, you should be heavily invested in the market, and in a bear trend, you should be completely out of the market. Studies done in America on the Dow Jones Industrial Index from 1900 to the present day show that if someone using a simple 200-day moving average had bought and sold on every buy and sell signal throughout the 120-year period, they would have done 10 times as well as someone who simply bought the Dow Jones at the start of 1900 and held the index until now. So moving averages definitely work, and they are a very useful tool in your analysis of shares. We suggest that when you look at a share on your software, the first thing you should do is apply a moving average to get a good idea of the trend, to eliminate the noise, and to smooth it out so that you can see what is really going on.